Okay, in this chapter, you will learn that all these financial ratios are used by who and for what. Okay, so the first main important person who will use this ratio will be from the commercial loan department. So, what's commercial loan department? These are like people like banks. So when they look at your company, when your company want to take loan, most company take loan, whether to buy car for business use or to buy factory, to buy shops, to buy things, basically they will take loan. So when companies want to take loan, the banks will need to see their financial ratio to see whether this company financial health is okay or not. When they when they buy something, can they repay their loan or not? All right. So if the company has a good financial ratio, then they will give loan. Another one is corporate controllers, which are the managers in the company, inside the company lah. Commercial loan are banks outside the company. Corporate controllers are usually inside the company. They will manage these financial ratios properly. They will look at these ratios, especially profitability, because they have to make sure that the company profit is high. Okay, the next one is CPA, Certified Public Accountant. These ones are sometimes by government. So government will or any other outside accountant, they will look at your company to see the financial health also, to see how dangerous your company is. Okay, whether it's very high risk, the financial health not too good, and so on. And the next one is chartered financial analyst. Also can be outside or inside people, inside of the company, to look at your company's profitability. Okay, it is very important, all these financial ratios. Why? Um, if you look at yesterday's news, do you know what your Prime Minister update yesterday? Prime Minister Muhyiddin, he updated something yesterday, come out in the news. You know what he updated? You know? Anyone knows? Can see? No one. Okay, late to pay loan. Yeah, correct. Not late to pay loan lah. So you have to know, the government know that everyone in Malaysia, especially those working, those people that are working, maybe you don't feel it, but one day when you start working, usually you have loan. Okay, what kind of loan? Probably you buy house, okay, or you buy a car. You need a car to go to work. But when you buy car, of course you cannot afford the car, because car will cost about what, 50 to 100,000. So unless you are very rich, your father mother help you to buy for you. If they didn't help you, you have only one way to buy a car in order to go to work. You have to buy with the help of the bank. You have to take loan. So when you take loan to buy a car, every month you have to pay back, every month. So during this MCO, man, some people lost their job. Okay, some industries like travel companies, hotel, MCO they cannot open. So during this period of time, some of them close down. So some people lose their job, and when they lose their job, they got no income, and they take some time in order to find a way to make income. Why they need to continue working? Because they have loan to pay. On top of they need the money to survive lah, to feed themselves, but they also need to repay their loan. The bank don't bother actually whether what car you buy, how much you need to pay, but they are only concerned of one thing, whether every month can you still pay your loan or not. Okay, so if you buy a $50,000 car and you take the loan for 9 years, okay, 9 years, so every month you have to pay back few hundred. So during MCO, people lose their job, they cannot even afford to pay this. All right, so what we say that if we look at their financial ratio, the financial ratio will not look good because they have very low cash flow, but they have very high accounts payable and things like that. This is on personal basis lah. Companies also same. Some companies don't earn income, so they cannot pay for their shop. They need to pay for their employee, but they don't get sales, so they need to pay for the rental and loan everything. So government step in to help. How they said, they tell the banks that, okay, all those people who cannot pay back, you have to extend the loan moratorium. Okay, they call it this word moratorium. That means to allow people to extend their loan and they don't have to pay for 3 or 6 months. So until year end, how much they owe, they don't have to pay first. Means delay payment. Usually in normal case, you cannot delay. If you delay your loan, the bank will get very angry. They will come after you, usually. But because the government says so, moratorium, so it is after discussing and agreeing with the bank. So the bank now allow people who cannot pay to delay their payment. Okay, so this is to actually related to financial ratio in order to help people with bad financial ratio. So they give an additional 6 months. Hope that in these 6 months you help yourself get a proper job change, and after that next year you start paying loan again. Okay, so this is to help this financial. So commercial loan departments or banks, usually they look at debt over equity. Okay, if you look at all the ratios that they look at here, all this that is in the list, the top one is the highest significant rating, down to the lowest. So the highest significant rating means how important is this ratio to them. So to a bank, debt equity ratio is important, current ratio important, cash flow, long-term debt is important. Why? Because they measure their debt level and liquidity. So of course, banks they are very worried about people's debt. Okay, if the debt is too high, they worry they cannot get their money back. And they also want to make sure that the company don't go bankrupt. So they make sure that the liquidity level is high. Okay. So all this you have learned before, all this ratio. We just want to see who and how people use it. Okay, the corporate controllers, most important at the top is earnings per share. All right, and they measure profitability. They don't care so much about that. Profit is more important. All right, you see, different people will use different ratio more. Certified public accountant will look more on the liquidity of the company. So they look at current ratio and account receivable turnover. CFA, Chartered Financial Analyst, looks at the return on equity after tax, also based on profitability. Okay, so if you look at this page, you see that loan departments, they have more green color, means they focus more on that. CPA, corporate controller, focus more on profit. CPA focus on liquidities or others or any other thing, profitability also. CFA focus on profitability also. Okay, actually this purple color is not profitability, it's liquidity lah. But anyway, from here you can see what is their focus. So I believe all of you have already seen a annual report. You downloaded a company's annual report, read a little bit, look at their financial statement. So if you have done so, you will have all this information inside the annual report. Okay? And these are the segments in the annual report: financial summary, financial review, management highlight, management discussion, president letter, and so on. So the most important, or the most that they will talk about, is earnings per share and dividend per share. These are the most talked about. All right. If not, then you also can calculate. Okay. So a lot of companies, when they come up with annual report, they usually try to be conservatism, and also try to improve the quality of earning. So no matter how bad the company is or how good, they will try to improve in their annual report using these methods lah. So of course, when they want to report something, especially their ratio, they want to make it look as good as possible. Like your house, when someone wants to come into your house is very old when someone want to come, of course you make it look nice as possible, as clean as possible. Although normal days is not clean, but when people want to come, you clean it, make it very nice. Okay, so same financial report, accounting annual report, they try to make it as nice as possible. So through conservatism. So how? So they will delay the reporting as long as possible, as late as possible, but not late lah, on time, but they will drag on until the last minute. Okay, so that they can still update the latest number. If you come up with it early, then a lot of updates you don't put in. Okay, so they try to also improve the quality of earnings. You have higher earnings. And as for fixed asset, some companies they will edit a bit. How do I say by edit? Means fixed asset, let's say a car, they will usually put it a shorter depreciation. So normal way is probably 10 years, but some companies with high earnings or so on, they will put 5 years depreciation. They want to depreciate it quickly. Okay, as quick as possible. So when they have faster depreciation, that means their expenses are higher. Later we'll see why expense higher is better for some. Okay, and companies will use intangible assets in order to increase their expense. So you see a lot of companies, I don't know whether some of your family got companies or not, but when they have companies, you go out to eat, right? You go out to eat, you buy some stationery, you buy computer even, then your parents will say, hey, this one, the receipt, pass it to me. So when they take the receipt, they can park it under the company's expense. Okay, they claim it under company. So that company will treat it as expense, they reduce their earnings, and they pay less tax. So They will do the same for intangible asset, shorter life, so that higher depreciation, higher expenses. Okay, pension as well. Um, so how do you see that a company is going to fail based on the ratio and analysis that you learn? So most financial failure, companies that fail, they will have problem with these things. Liquidity, um, deferment of payment of debt. That means they delay their debt payment and they do not pay their preferred dividends. Okay? But there is no criteria to say that, oh, when this happen, this one definitely company will fail. No. But how does it mean when company fail? When they have problems with all this. Okay? Any company can fail. Alright? So So how to forecast, how to predict that a company is going to fail? They can use a several models. Okay, the top one is to build a model. You look at uh, you look at this at the bottom here at the bottom, recognize model, univariate and multivariate. Okay, univariate model means the company financial failure is based on one factor, one reason, one ratio only. You look at this ratio, then you know that the company is going to fail. Okay? And another way is the multivariate model. Multivariate model don't look at one. They look at multiple, a few. A few ratio will show you, oh, that this company is going to fail. Okay? So, these model are used by management, investors, creditors, and auditors to assess the company's financial health. So who will use this model? All these people, mostly stakeholders lah, internal and external. Okay, different reasons why they use it, but they all use the same. So what is the univariate model? So univariate means single variable, means single reason. So we look at the company that is going to fail based on the cash flow over debt, or the return on asset, or the debt ratio. So we can compare, let's say we compare A and B, two company. We compare cash flow total debt. Okay, so if this one is 2 and this one is 3, A cash flow over total debt is 2, B cash flow over total debt is 3. So if you look at one ratio alone, we say that the bad one will fail. Which one will fail? This one, no? Okay, we only look at one. So the ratio that shows that the company is not doing so well shows that company A is likely to fail, because you only look at one variable, one ratio. So why do they say that these three are more popular to identify whether the company is good or bad? Because they have observed in a long history that companies that fail, they have less cash. So this one, you look at cash flow. Companies that fail have higher receivables, higher debt. Okay. Companies that fail have less inventory. So these are the signal that the company is not doing well and is going to fail. Okay. So this is a univariate model. Then next model is multivariate model. Okay, you look at this, it may look a bit complicated, but the reason is the way to understand is very simple. So they want to find Z. Okay, so what is Z? Z is Z score, and they say that the lower the Z, the more likely the company is going to fail. So we just use the information here to calculate Z, no? To compare A and B. Let's say we want to compare A and B. A company and B company. So we compare A punya Z and B punya Z. Okay, so let's say AZ is A Z score is 1.1 and B Z score is 1.3. So which one is more likely to fail?
A.
Lower Z score. Okay, so that one is the first thing you should understand. The next thing you should understand is how to calculate Z. How to calculate Z? You have X1, X2, X3, X4, and X5. These 5X will contribute to calculate your Z. So what is X? Okay, X1 is working capital divided by total asset. X2 is retained earning divided by total asset. X3 and so on. So X1 to X5 is different ratio. So you calculate all this ratio. All these ratio will combine to find your Z. And what about this is X? So you have to calculate and replace the X. So what about this 0.12, 0.14? All this is not calculated. All this already give. So what is this? This number here is how big is the impact of your X. Okay, so if you look at X1 to X5, which one is more important? X3 is more important. Why? If you look at the number in front of X3, 0.33 and 0.033, this number is larger than everyone else. You see? 0.012, 0.014, 0.006, 0.01. So 0.033 X3 here is the largest number. So largest number means this is more important. Okay, so what is X3? Earnings before interest and tax divided by total asset. So this factor is more important to find your Z. Okay, which is the less important one? Less important one is this, X4. Okay, why? Because the number before the X4 is very small. What is X4? Market value of equity divided by book value of total debt. So this one will affect your Z, but only by a very small amount. Okay, so I hope you understand what this model means now. A big number in front of the X means this one is very important. The small number behind your in front of your X means this number will affect the Z, but it is not so important. Okay, less important. All right. Any questions so far? Yeah. All right. So, in order to forecast financial failure, so many people try to forecast. They try to look whether which company is doing well, and at the same time, they also want to see that which company is going to fail first. Why? Because if they know which company is going to fail, then they can exit. They can quickly get their money back. So a lot of studies exist that they look at which ratio will show that the company is going to fail. But no conclusive model. No one model can be used. People use a combined model. So how do we know, like sickness, sickness? When you ask doctor whether this person got COVID-19 or not, they don't just say, oh, this person got flu, sure got COVID-19. No, right? They will look at a few symptoms. One, you have flu. Two, you have coughing. Three, when you eat, you got no taste. Four, your skin is itchy. Okay, so people look at a few factors, a few things, then they will conclude that, oh, this person got COVID-19. Same for companies, they say that, oh, this company is going to fail. What reason? Or because their profitability is low. One reason is not enough. They need a few. Okay, to be more certain. Unless if you just base on one, then every one factor, that means everyone also got COVID-19. Flu a bit, oh, this one COVID-19. No. So financial failure of the company, same. Profit low don't mean that, oh, going to fail. No. You must have a few indicators. Profit low, high debt, low asset, and so on. Okay. So, in the review procedure, that when people analyze, sometimes auditors will isolate certain item. So they say, oh, this one is more special. We will have to look at it on its own. We don't combine and things like that. So the stages of audit, when people audit, they will do planning and test and review. They will actually look into every part of your financial report of the company. So audit actually do a very very thorough check. They check very properly of a company's financial health. As for management, why do they use analysis? So as you are doing the final assignment, what you are doing is you are doing financial report analysis, because I give you your task. That means you have to look for one company, you have to analyze. But in the future, when you do this, you don't do it anymore, right? You won't do it because now you have to do it in order to pass your paper. But in the future, when you do it, not because you want to pass the paper, but because people pay you money to do it. Who pay you money? Okay, it can be inside of the company, it can be outside of the company. Anyone can pay you for you to do analysis because this is your knowledge. People pay you to use your knowledge. So if you are the company's management, you will use this analysis to look into the company's financial ratio in order to help them. Okay, if you are from outside, that means you are outside people trying to analyze a company. You are actually using not to help the company, but actually to see if this company is good or bad, good for investment or not. So from different perspective, outside and inside, you have a different reason of analyzing. All right. So if you are inside the company, you do analysis is to see whether your objective is achievable or not for planning, and also for budgeting, for planning or budget for the next year. You have to do analysis. So example lah, if you are inside the company, you do analysis, you see that, oh, your company, your profit is very low this year. So next year, what is the plan? How do we improve the profit? Oh, we need to launch more brands or something like that. We have to come up with more innovative marketing to sell our product. These are the budgeting, planning. Okay, so when you do your analysis, you can actually explain better when you do it in graph. So like this company, you can do a line graph to show that, oh, in 2002 to 2006, our net sales has increased. Okay, then up to 2005, 2006, the net sales didn't increase much. It increased very little. Okay, what is the reason here? Then you can analyze. Maybe because this year is like COVID-19, people don't go out much, so they buy less. That's why the sales affected. Something like that. Okay. The next kind of information that you can table so that you can see properly is like this column graph. Okay. April, May, June, July, August, September, every month got 3 colors. So one color represent one product. Okay, so if you look at like June, what people buy the most in June? People buy socks. So you say, hey, socks is not bad. Why? What happened here? Why people buy socks? Maybe because April, May, June, uh, students go to school, so they buy socks. And July, August, September onwards, why no more socks? Because maybe they go to the school is going to end, so they buy all their socks already. They buy less socks now, and so on. Okay, so you can look at this in order to plan for your future sales. The next one is a pie graph, is to look at different segment of the market. So the total of this whole pie is 100%. So if you look at sales, if you want to look at sales of your company in different countries, so you can see that, oh, USA give you 34% of sales or profit. Asia give you 22%. Europe give you 26%. This is very important. For example, any one of you using iPhone? iPhone. So those of you using iPhone, and even those of you who don't use, but you know what is iPhone, right? The latest model, iPhone 11, is quite expensive, right? It's not cheap, right? So iPhone is well known for high-end products or high quality, high-end. But recently, they they know that a lot of their business, they found out, they draw a pie chart. Maybe they draw a pie graph, and then they found out that, wow, the business all from US, Europe, and other countries. Asia very low, you know. Why? Because for Asian people, iPhone is too expensive. Only the rich can buy. So what they do? They come up with a new product. They call this as the iPhone SE. You heard of it? iPhone SE. SE, they call it as a special edition. Okay? iPhone SE. So iPhone SE got the top top uh what do we call, software, and also the chip. Everything is new, but it is made of plastic, and very low cost. So that this iPhone SE, they can sell below 2000 at a very low price. So this one, they noticed that, oh, because of SE, the Asia part in the pie grew much bigger. So they know that Asia population is very high, like China, India, Malaysia, all these are very high. Even Indonesia. So by targeting this segment, they found that their sales increased by a lot. So this pie chart help with your analysis and executing your plan. Okay, it helps a lot, pie chart. Okay, so So the management of earnings, there are few ways to manage your earnings. One is cash based and accrual based. As you learned before, people still use cash based accounting, but the better way is using the accrual base of accounting. Okay, accrual basis is the proper way, because cash base is only recognizing revenue when the cash is collected, rather than accrual based accounting where revenue is recognized when your product is delivered. Okay, so management of earnings, when they recognize earnings a different way, it is easy to manipulate. So let's say you have two cashier, one cashier or one accountant use cash basis, and the other use the accrual basis. So when two different accountants use different way, it gets very confusing. All right, so it will cause your estimate to be different and your judgment to be not right, because so one person recognize cash, one person recognize accrual, so it will not be right. Okay, so revenue recognition is where most company use to do financial manipulation. Example, your company want to show high sales, but they are not doing well. Okay, so they want to show high sales so that they get bonus. So how to show high sales? How to show high revenue? So let's say the cut-off date is 30 very much April, May, June, July. 31st July is the cut-off date, is the due date. Okay, so 31st July you need to come up with a annual report. So by 31st July until today, today almost 31st, but your sales is very low. So how? So what they can do is they can call their customer and deliver all the goods. They say you don't need to pay, we deliver first. So when they deliver, they consider as sales consider as revenue when you deliver. Right? Because you don't collect, it's fine. Because your revenue recognition is based on accrual basis. As long as you deliver, consider sale. So they deliver as much as possible. They don't care whether people can sell or not. They deliver first. So that is very dangerous for the company. Because you deliver to recognize revenue, but in the end, whether you can collect payment or not is a different thing. Okay, so one example that people have manipulated accounting in order to make to cheat people one example is Enron in 2001. They have reduced their tax income by 500 million, and in November they restated their net income 19 for these 3 years, and in December they filed for bankruptcy. So what they do, they actually cheat the people. This company is not doing well, the income is very bad, but how come after 3 years only people found out? Because they use a very complex financial statement. So when you look at the financial statement, very hard to understand. You don't understand. And a lot of question marks. Okay, a lot of question marks. So you don't understand how is this money come in, how they recognize sales, how they recognize revenue. Do they use accrual or do they use cash, and things like that. So they have techniques that they use to avoid people from finding out that the company is not doing well, is doing badly. And the second company is WorldCom. where in 2002, June, they show that they have a 3.8 billion, but this amount is overstated, means the fake profit is not real. So after that, in the same year, in November, they report that they are actually making a loss. Okay, so the court reported improper accounting that exceed 7.2 billion. So instead of making a profit 3.8, they are actually making a loss. All right. So how do they do it? They capitalize operating costs. So operating costs, they put it under asset, or how they capitalize it lah. All right. And they move funds from one account to another account in order to show profit. So it's like my department A sell to my department B. So here I show a revenue and I also show profit. But B will not pay A, and so on. So A and B is both inside my company. So that one they show profit, but actually they don't make money. Okay. And the last one is not last one. The last one. Fannie Mae and Freddie Mac is two companies in the US that they actually provide loan for people to buy house. So like now you want to buy house, right? You go to the bank and the bank will give you loan. So in the US, these two companies give you loan to buy house. All right. So what they do is they reported the liquidity and they reported all this fake data so that they can continue give loan. They can allow you to buy house. But in fact, right, they have no money. They just say, oh, you can buy house, we can buy house, we sign and you can buy house. But actually, their financial management is very there is problem, and when one day people find out, hey, something is wrong, and the whole thing collapse. So this Fannie Mae and Freddie Mac actually collapse. Okay, so the next thing you need to learn is about restatement of financial statement. So restatement is also a problem because companies that are being analyzed for restatement, that means the company annual report, financial statement may have some problem. Okay, that means they record certain things wrongly. So they have to do a restatement. They have to, like your assignment, you do it wrongly, you redo. So this financial report statement, they need to do a restatement. Okay. So I think I've finished this lah. Is it okay if I don't go for a break? I can continue, and we continue and end this, or you need a break? Do you need a break? Late to pay loan 850. Hey, Wing Hong, what do you mean by late to pay loan? Sorry, I just saw your message. You still remember your question? Late to pay loan? Hello? Everyone? Yeah. Sorry, I think I answered that already, right? Blur already. Okay, can I continue to finish up, or do you think you all need a break? We want to have a short break, 10 minutes. Everyone, are you here?
Yes.
So we have a short break lah. Okay, short break. Okay.
Can.
All right. I'll see you later. 10 minute break. I'll see you soon. Hello, everyone. Hope you are back. All right. Okay. Those who have not checked with me on your company, uh, please let me know what company you want to do. Azlan, Jingwen, and some others. All right. Just check with me whether the company you are doing okay or not. Better than later when you do halfway, then you find cannot do, not enough info. That time will be too late. All right. So if you are back, let me continue and finish up all this. Okay. So let's continue. Um, Apart from your ratios that you use in order to see whether the company is possible to fail or not, based on your financial report analysis, the other thing that you can do with the information is to value the company. All right, so valuing a company is not easy. It's just like valuing a land. So when you buy land, how do you value this land? So there are many different ways to value something. Okay, especially land, they have no value. So how do they come up with the value? So they calculate based on the certain pricing and also the potential. Okay, this is when you value land. But when you value company, how? So there are many ways. So the approach is there are two lah. One is fundamental analysis, and the other one is discounted valuation model. So these are the two ways. So the fundamental valuation is based on accounting measures such as cash flow and book value. Okay, usually they use this price to earnings, price to book ratio to calculate the value. And this is not well accepted by most financial uh, literature or financial experts, but it is usually used by security analysts and fund managers. Okay, why? Because this is probably not the best way. Okay, the more safer way to do it would be the discounted valuation model, and this is strongly supported, but it is not widely used. So how do you do discounted valuation model? Based on residual income and based on earnings. Okay, and the earnings and discounted cash flow model. So if you learn if you are taking this other subject called finance in your diploma, you are taking another subject called finance, and this finance module will teach you about discounted cash flow model, how to discount cash flow. Okay, present value, future value, all those I'm sure you know. Oh, other these are the ways of discounting earnings. Discounted of normal abnormal earnings and also discounting residual income. Okay, the other one will be discounting cash flows. So the most popular one will be the free cash flow. So how do you calculate free cash flow? Operating cash flow minus interest minus cash payment outlays, debt repayments, and preferred dividends. You minus all this, you get your free cash flow of this year. So once you get free cash flow of this year, you can actually predict your next year free cash flow, and you can predict your every year free cash flow. So I know that my company free cash flow is this amount, 1 million for this year. So I can actually use this 1 million to predict my next year and 2 years and 3 years later. Okay, because it will not change much. Usually it don't change so much. And dividend discount model, the same method, you use present value, discount it back to today. But dividend, this one is based on dividends that you pay. And another one, instead of using free cash flow, you use cash flow. You don't minus anything. You just use your cash flow. Okay? You just use your operating cash flow. So different methods have different way of interpreting your answer. Okay, so here they show that what different analysts use lah. Some use PE ratio, some use market to book ratio. All right, and most of them will use discounted cash flow because discounted cash flow provide a more reliable company valuation compared to earning multiple, compared to the what we call as the earning PE ratio, all those. Why? Because this one focus on the cash flow of the company, and it focus long term, all right, rather than short term. Okay, so basically this is everything that we cover for this chapter. No calculation, no calculation, but this is to summarize what you have learned in the past chapter, chapter 1 to chapter 9, what you have learned and how is it being used in real life. So everything that you learn here is actually very relevant to your to real life lah. So that is why your assignment is very special, that you can use real life annual report. Okay, some things that you learn, right? Oh, you cannot apply because limited information. But no, not this. This ratios and methods that you learn, you can actually apply immediately in real life. So that's why your final assignment is very interesting, where you can actually use real companies' annual report and you can do the ratio. And once you do your ratio, and when we see later, one company and another company, you can see the findings is very interesting. Let's say one of you do DG, another person do Maxis, and we can compare because it is the same industry. We can compare what is the income to asset ratio, what is the return on equity, which one is higher. All right, so this is very interesting findings if you have done. Actually, all this ratio, people are already using it. People know how to calculate. It's easy to calculate. Even in your final assignment, it's easy to calculate. You just need to, base on the formulas that you have learned, calculate. All the information is there. And the calculation part is not difficult. But the difficult part is to explain your calculation. So if you compare 2017, 2018, and 2019, you compare, you must know what to explain. What information that you get and you understand from your calculation. That is more important. So the explanation part is more important than the calculation part. Okay? Just a reminder for you. Okay, so any questions so far? You can ask questions regarding your final assignment also, so that everyone can get the answer lah, so that everyone will know. Any questions so far?